Hello, we are ready for chapter 6 of our, now we're in module 4, and I think you'll find that this is one of the easier chapters. There's just only two concepts we're really going to look at. We're going to look at doing a bank rec, which is a really important thing. You might think, oh, that's kind of outdated, but really it's not just with a checkbook and balancing your checkbook. Now you can balance with credit cards. It's still something you definitely need to do. Make sure that your money in the bank is what you think it is as well. Make sure your books line up with what the bank says and you didn't miss something, or perhaps even the bank made an error. So the whole reason we do a bank reconciliation here is to figure out why there's a difference between what our cash says on our T account and what the bank says at the ending balance. They're almost never going to be the same. And that's because there are things that the bank knows that the company doesn't know yet, and we won't know them until we look at the bank statement. And then there are some things that the company knows that the bank doesn't know yet. So we know that we spent money and we wrote a check, but it's still in the mail, and the other client that we sent it to hasn't put it in the bank. So therefore the bank still says we have more money than we actually do. So we don't want to necessarily always just know and see, oh, well, the bank says we have $9 grand, so therefore we need to adjust our books up to 9 when we really only have 7,500, and that can make a big difference. So a few things, some new terminology. These first two items, and these are really the only two items that we know about as the company that the bank doesn't know about yet per the bank statement. So one of the items is called deposit in transit. And this is simply if you have made a deposit, or even if you haven't made a deposit, but you've collected the money and you're waiting to take it to the bank, you know that you have the money. It's just the bank doesn't know it yet because either A, you haven't made it, or B, you made it after the statement date, after that cutoff. Sometimes you'll see a little placard in the bank and it'll say transactions after 2 p.m. will be on the next business day. And that would be considered a deposit in transit if you made it after 2 and then you cut off your books that day, and therefore it's not going to be on the bank statement. So therefore, if this happens, you got to think about how does that affect my books versus the bank statement. Well, you have recorded the money, and so you know you have it, so therefore your balance is going to be larger than what the bank says. The bank doesn't know that you have that money yet. So that's how that's going to be affected, and we're going to see how to do that in a bank statement, in a bank reconciliation. The other thing that you know as the company, but the bank doesn't know, are what's called outstanding checks. And these are checks that you have written to one of your vendors, and they just haven't deposited it yet. So you know that you're going to be out that money. Just it may be another day or two or a week, but you can't rely on what the bank says because they just don't know that you wrote this. Now, any of these items we already know about, so we don't adjust anything in our books. So that's when we come down to the next part. So anything from here on up, we've already made the journal entry. We've already adjusted our cash T accounts. Therefore, anything that we do on our side of the bank rec to adjust the bank's numbers, on the bank side to adjust the bank's numbers, we don't make a journal entry. You've got to try to remember that. Anything that we fix on the bank side, and you can see over here, I've kind of got it started up. We're going to have two columns on a bank rec. We're going to have a bank column, and then we're going to have an R column. Anything that we change on the bank side to adjust their books, because we can't really adjust their books, but we can pretend. And anything we do on the bank side, we don't mess with on our books because we've already done it. We already knew about it. It's whenever we come over here and adjust something on our side that the bank told us that we didn't know, then we have to adjust our books. So back to the outstanding checks, think about how that's going to affect and look on our cash T account. If we have outstanding checks, that's going to make our bank balance, our cash T account lower than what the bank says. So that's going to be another reason why there's a difference. The rest of the items that I have here are things that generally you'll find on the bank statement that we didn't know about or we just forgot about, perhaps. And the bank is showing, hey, we had this happen, you need to adjust your books. So sometimes if you're a company that collects deposits and maybe you're a landlord and people put money into the bank instead of going through you as the middleman and then you putting it into the bank, some renters do it like that. Maybe you didn't know that that happened, or perhaps even if you get a direct deposit into your account from your work pays you a direct deposit, you may not know exactly how much was put in there. If you didn't look at your pay stub, then you look at the bank statement and then you adjust your books accordingly if they get a collection. Sometimes you'll have little bits of interest come in from the bank. So those are items that you didn't really know about. So you'll have to increase your income perhaps just a little bit. And that would require a journal entry to show that your cash went up. This is one that you hope never happens, but this is non-sufficient funds check. That means that's a check that your client wrote to you and they wrote it out for $200 and then you put it in to the bank. You put it onto your Cash T account and you said, we got the money. You didn't know otherwise. The bank says, no, you don't. The check was denied. They didn't have the funds in their account. So therefore, it's going to come back to you. And a lot of times there's even going to be a penalty assessed on you for whatever reason. I don't like that. I think that's a tough rule that not only do you not get the $200 that your client paid you, but then the bank assesses a $30 fee. So then you've got to go back to your client and tell them that they owe you the $200 and the $30 fee. You're like the middleman. So that's never a good situation to be in. Either way, if you're the one that actually wrote the check and it bounced, or more likely that your client wrote the check and it's bounced. So what that's going to do, therefore, if the check bounced that we received, that means our cash is too high. We're going to have to take money back out because our client never really paid us. They thought they paid us, or they knew what they were doing and paid us out of a bad account anyway. But regardless, we have to take money out of the account. And what we do then is put it back onto the client's AR account, put it back onto their bill plus any penalty. A service charge, a lot of times business bank accounts have a fee monthly or maybe quarterly. They may assess a bank fee. That's something that we'll have to remove from our cash because the bank's taking money out of our account to allow us to bank with them. And then there's always the unknown, the error. The error could be we just forgot to write it down. It could be that we transposed numbers. Instead of writing 746, we flipped the first two numbers and wrote 476. And so that's going to make a big difference in our cash balance. Sometimes it could be the bank's error, but most of the time when we do examples from the book and with the examples here in this lecture, we're always going to assume that it was our error, and we're going to make the adjustment on our bank rec and do the journal entry to fix our books. All right, so with that, I think this is best to do an example to see how all this works out. So when we do this practice example, what I would do is either on a sheet of paper or pull up Excel like how I have it here. And we're going to make two columns. We're going to do the bank side and then leave something over here, leave a column for all the different items that we're going to put. And then we're going to see, does it affect the bank? Do we need to adjust the bank's books? Or do we need to adjust our side? So when we get to the end of the month and we look at the bank statement that comes to us, it says the bank shows our cash to be $8,450. And I just have, this is a date from another problem. Let me just update this. This would be, from this one, it's on 6/30. So don't worry about the dates on this one. And when we look at our T account says, hey, we think we have more money than the bank says. It shows we have $91.30. So why is there a difference? So when our whole goal, when we're all done and we get down to the bottom, we want this to kind of be like a trial balance. where both sides need to be the same when it's all said and done. All right, so the first thing, we go through the bank, and I already have them laid out, so we didn't have to go through and search, but in a real life you would. You would have to compare your books and your items that you wrote checks for or deposits out of your debit card, and compared to what the bank shows that happened. And then mark each one as you go through that matches. And then if there's one that you wrote a check for that the bank doesn't know, that's called an outstanding check. So that's something the bank doesn't know about. We need to record it on the bank side. We need to pretend adjust the bank's books. So when we adjust the bank's books, we need to show that we wrote a check for $621. So we need to pretend that the bank knows that and then deduct $621 from the bank side. And then put out here what check it is. So then in the next month, I can go back and see, oh, did this check actually go through? And if not, then it needs to go on the outstanding check again. And then we need to do that for all 4 of the outstanding checks that we found. Each of these is going to be a negative on the bank's side because we need to pretend that the bank knows about it. And then just the opposite, we made a deposit late on June 30th that the bank is not showing on the bank statement. So we need to pretend, because we know it happened and it's on our cash, we need to pretend that the bank knows about it. So we call that a deposit in transit. Again, it's affecting the bank side, pretending that the bank knows about it. So those are the only 2 main things that you're going to find that we need to adjust on the bank side. Everything else is going to be over here on our side. So the next thing we find is an error. Number 3, we're looking at, and it's not a outstanding check because we know about it, the bank knows about it, it's just that the numbers don't match. We flipped the last 2. So the check was actually written for $862. That's what we actually wrote it for. That was the correct amount. But when we put it into our journal entry and then into our T account, we put it as $826. So we need to make an adjustment on our books. This would be like an error. Whenever there's an error, you can do it one of 2 ways. Here, what I did is I just combined it, and that's going to be how the book does it. But when I do it in class, I like to actually do it and do it where it's a little easier to see. I'll just put it out here to the side just so you can kind of get an idea what I'm saying. Technically, yes, we need to adjust our books by -36 because we only wrote it for $826. So if I pull up the calculator and I said we took away $826, but we really needed to take away $862. The difference there is $36 that I need to take away some more out of my cash T account to get me up to that $862. But if you can't quite think like that, if that's a little harder, out to the side, what you could do is think, okay, I need to get rid of this, pretend that it didn't happen because it was an error. So add back 826, and then just below it, take away what really should have been, 862. And then if you do these as a net and combine them, you'll see that the sum is -36. So you're undoing the wrong thing and then taking off what really should have been 862. Now, anything on our side, we need to have a journal entry. And I went ahead and just did it as the one combined. And I'm showing over here that we need to take off an extra $36 from what we owe. We don't really owe that extra $36 because we did pay it. And we need to show that our cash went down by $36 more because we had only added at 826 as a negative instead of 862 negative as we are losing cash. You could have done the journal entry like this and said, got rid of this entry on both of them. I'm only going to show you this one just so it's not confusing, but you could have done it this way as well. Either way works. I just went ahead and did it the way the book does it here and put the 36 as the summary. Okay. Control this. Okay. I'm going to take this off and just put it back up. Just give me a second here. Okay. All right. So we took care of the error, we fixed that. Now we're ready for the bank service charge. The bank is saying you owe us $13 for taking care of your account. We didn't know about it, so we need to show that $13 is now gone from our cash. And when I do that, I come over here and I show that $13 is gone from our cash with a debit to why it's gone. It's gone because we had an expense, a bank expense. Now we come down here to Hersey, and Hersey wrote us a check for $180, and we took it off of our account, or we took it off of his account and put it into cash because thinking that it was a good check, but it bounced, and it shows us that on the bank statement that it was a non-sufficient funds. And not only that, the bank charged us a $25 return fee. So they took away they not only gave us the $180 that we thought we had, they took away $25. So when I come down here to my bank, I need to show that not only did I not get the 180, they took away another one. They took another 25 out. So a total of 205 I need to take away from my cash balance. Now this return fee, I don't call this an expense. Think of this as like FOB shipping point, where the client pays it and then you're kind of like the middleman, or think of it as like, we'll talk about this in another week or two, sales taxes. With sales taxes, you as the retailer collect them, but it's the customer who's really paying it, and then you pay the IRS, so it's not an expense even though you're paying the IRS. Same thing here, the 205. I'm going to come down here and I'm going to, I just need to change the name here to my new client. My client, I need to put it back on their books for $205 that they owe me, because they owe me the 180 that we originally thought they paid me, plus the $25 fee. And so they're going to tack on, when they do it on their side, they're going to say, oh, we have an extra expense that we need to add on because we wrote a bad check. And then we need to show that our cash went down by $205. Because we not only didn't get the 180 that we thought, we didn't get the extra 25, they took that away. And then finally, here was one that's just basically an omission. The owner took some money out, Dr. K, and forgot to write it down. We found it in the bank statement. So we have a $50 withdrawal that we need to go ahead and take care of on our books and show that we no longer have that 50. Now everything so far was on the negative side. It's not always that way. It just happened to work out. So don't think that everything on our side is always a negative. It's not. The error could have definitely been the other way, where we had taken out too much money and then we needed to add it back. So when we do this omission over here, we need to show that we had a drawing or a dividend. Remember, those are synonymous terms. We could call it either way. And then we credit cash to show that we don't have that money that we thought we did. Now, when it's all said and done, we need to go ahead and total both sides. We need to start at the top and then combine everything that happened. And we see that our new, if we were looking at our cash T account, our cash T account is now showing $8,826. And the pretend bank balance is also showing $88.26. So we know that our cash is now up to date. So up here, the cash amounts for both of them neither of them were completely correct. So we can't say that, oh, well, the bank, we need to adjust our books to the bank's numbers. No, because the bank didn't know everything, just like we didn't know everything either. So that's an example of a bank rec. And that's the harder of the two things we're going to do. But it's a very important thing to know how to do. The other thing that we're going to look at is a T account that's just like cash. So if cash, you remember on our T accounts, is up there at the very top left under the assets, just below that, we could add a new account called petty cash. Petty cash is cash that you have in your office to pay for little things. Think of your cash T account as your checking account, what you have total. Your petty cash is a separate little subset of cash that you have to pay for small little things instead of writing a check for every little miscellaneous thing that comes across your desk. So, okay, we have the petty cash here to make quick payments. Basically, you'll have a rule in the office that says anything under this dollar amount, we can go ahead and pay out of petty cash, and we don't need to have a check record for it or the owner to sign it. The office manager or somebody else can go ahead and make those payments as petty cash. And then anything above that does need the owner's approval, perhaps. What we're going to do is anytime we take money out, we're going to have a little notepad off to the side, and we're going to write down what we paid, how much we paid, and then what it was for. Because then at the end of the month, we're going to total everything up and make one big journal entry that shows everything we paid. And then to reimburse our petty cash, we got to take some cash out of our checking account and put it right back into that drawer. So that's what's going to happen at the end of every month. So what we're going to do is we're going to set up a petty cash. We're going to start it out from scratch. And then we're going to have some monthly transactions. And then we're going to replenish that account at the end of the month. And then maybe the owner decides to start the next month, we need a little bit more money in there because we didn't have enough to pay for everything. So we're going to see how that looks to re-up our petty cash to even a higher amount. All right, so when we, at the end of the month, we're going to debit the appropriate expenses, and then we're going to credit cash because we're taking money out of our cash T account or out of our checking account and putting it into the petty cash account. And so petty cash really doesn't exactly change. You can do it. There's not necessarily, you can credit petty cash and then do another entry. It's just doing 2 entries instead of 1. That's fine. That's sometimes how I do it in class to make it so it's easier to follow. But really you can just say, okay, I'm going to take that $75 that I paid little payments throughout the year and take it out of cash and put it into the petty cash. You're going to see how that looks here in just a second. But just before we do that, just because in my little notepad, let's say I wrote down that and added everything up and it was $72 that I paid out of 100. Let's say I had 100 in my petty cash and I added up everything in my little notepad and it came up to be 72. But when I counted out what I actually have, I only have $25 left. Well, if I wrote down 72 in expenses, then that means I should have 28 left. But somewhere $3 left and I wrote it down wrong. Something happened. Maybe I gave somebody a tip and I forgot to write it down. That would be what's called a cash shortage. And this is just like an expense account. It's when your cash that you have on hand, we only have 25 instead of 28. When your cash on hand is less than what it should be. Either from, I put here from the register, that would be like if you were doing if you were actually at a cash register, but the same thing happens with your petty cash account too. But it could be also over. Maybe you wrote down too much. You thought you paid 30, but you only paid 20. So your cash on hand is higher, but you don't know where that error happened. So when we don't know where the error happened, we call it a cash shortage or cash overage. Basically, it's to fix whatever the actual cash on hand says it is. So let's do this practice example here. So the owner of the Dr. K, He's the owner of his office, the practice that he has, and he decides to open up a petty cash fund to pay for small little things, today being the first of the year. And then at the end of the year, we count up the drawer and there's $22 remaining in the petty cash drawer. So what we're gonna do is we're gonna record this initial opening of petty cash, and then we're gonna record what the drawer says. The drawer shows that these were the items that we paid money for. And we need to see if it actually equals to being $78, because if you take 100 minus 22, that means I spent 78. So we're gonna see if that comes true. And then we're gonna open up February and go ahead and up our amount to 130 just to make sure we have enough in the petty cash. So not only are we gonna have the 100, but we're going to add on $30 extra. Okay, so when we first start this, we need to open up our petty cash account. So we go down to the bank, we take out $100 of coins and small bills. So we credit our cash, our checking account for 100, and just basically putting it in a different spot, putting it in a petty cash instead of regular cash. So we still have the money. It's just taking out one asset and putting it into another. Now, throughout the month, I had all this happen. So on January 31, I look at my little notepad, and I'm going to show that I bought supplies, so debit my supplies account. And then I had some postage that I can expense, office expense for the lunch that we had. The owner took money out. And if I add all these up, remember it should equal to be $78 because I have 22 left. So when I add all these up, let's see how close we are to 70. We're just a little bit above that. I should have been able to explain, or we were not below it, we were below it. I should have been able to explain $78 of expenses because I only have 22 left. But obviously there's some kind of a difference here. I didn't quite get up to 78. I forgot to write something down. So I do the difference. I forgot to write something down for $4.65. So I need to show that, because I can't remember what it was, as a cash short and over. It's called a little bit different depending on which book you use in terminology, but typically a lot of times it's called cash short and over. Now notice here, you could call this petty cash and then make a separate entry, but we're gonna combine that and only do one entry and show that we're gonna replenish our petty cash account at the end of the month. And we're gonna come down to the bank, take out $78, and combine that with the 22 I already have. So now I'm right back to 100. And so when I went down to the bank, I took out 78. So I need to show that my cash account went down $78, put it into the petty cash. Notice I didn't need, nowhere on here did it show that petty cash went down. So it's just, now I know that at the end of the month, I'm back up to 100. And then the only thing left I have to do in February is I decide I need to take out $30 more. So I take out $30 more out of cash, out of my checking account, and I put that into petty cash. So now my petty cash is not only at 100, but now it's at 130 and to start the month. That's really all there is for this week's chapter. So when we get into our second segment here, we are going to look at just a couple problems and see how Connect does it as well. So we will do that in our segment 2.